Hey everyone, and welcome to your channel. Today we're diving into the world of high-yield ETFs. You know, those exchange-traded funds promising chunky returns. But are they too good to be true? We'll be looking at some specific ETFs, QYLD, XYLD, and DIVO. Now, these guys don't rely on companies paying out dividends. They use a strategy called covered calls to generate income. Sounds fancy, but what does it mean? Stick around, because in the next few minutes, we'll break down exactly how covered calls work, the juicy income potential of these ETFs, and also the hidden catches. So, buckle up and get ready to learn if these high flyers are right for your portfolio. How does the covered call strategy work within QYLD, XYLD, and DIVO ETFs? QYLD, Global X Nasdaq 100 Covered Call ETF, XYLD, Global XS&P 500 Covered Call ETF, and DIVO, Amplify CWP Enhanced Dividend Income ETF, all utilize the covered call strategy to generate income for investors. Let's break down how it works. 1. Underlying holdings. QYLD and XYLD. These ETFs hold all the stocks that make up their respective indexes, the Nasdaq 100 for QYLD and the S&P 500 for XYLD. This provides exposure to the performance of those underlying equities. DIVO. Unlike QYLD and XYLD, DIVO doesn't directly hold individual stocks. Instead, it invests in other ETFs that focus on high dividend-paying companies. This gives it exposure to a basket of dividend-rich stocks. 2. Selling covered calls. All three ETFs sell call options on a portion, or all, of their holdings. These calls are typically at the money, ATM, meaning the strike price of the option is close to the current market price of the underlying stock. By selling these calls, the ETFs collect an upfront premium from the option buyer. This premium represents the income generated by the covered call strategy. 3. Key considerations. Capping upside potential. If the underlying stock price increases significantly above the strike price by the option expiration date, the option will be exercised by the buyer. The ETF will be obligated to sell the stock at the strike price, even if the market price is higher. This caps the potential gains from the stock appreciation. Limited downside protection. Covered calls offer some downside protection compared to simply owning the stocks. If the stock price falls, the investor keeps the stock and the premium received from selling the call option. However, the protection is limited, and the stock price decline can still result in losses. Additional points. These ETFs typically roll their options contracts regularly, meaning they sell new calls before the existing ones expire. This allows them to keep collecting premiums. The amount of premium earned depends on factors like the stock price volatility and the time to expiration of the options. What are the trade-offs between income generation and potential capital appreciation with covered calls? The covered call strategy offers a compelling benefit, generating income through option premiums. However, this benefit comes with a trade-off that impacts your potential for capital appreciation on the underlying stock. Here's a detailed breakdown of this trade-off. Income generation. Selling calls equals premiums. Covered calls involve selling call options on a stock you already own, or an ETF that holds the stock. The option buyer pays you a premium in exchange for the right, but not the obligation, to buy the stock at a specific price, strike price, by a certain date, expiration. This premium is your income. Regular income stream. By strategically rolling covered calls, selling new calls before existing ones expire, you can create a regular stream of income. This can be attractive for investors seeking dividend-like returns without relying solely on company dividends. Potential capital appreciation. Capped gains. This is the key trade-off. If the stock price increases significantly above the strike price by the expiration date, the option buyer will likely exercise their right to buy the stock at the strike price. You, as the seller, are obligated to sell your shares at that price, even if the market price is much higher. This captures potential gains from the stock's appreciation. Missed outperformance. Let's say the stock price skyrockets. Without the covered call, you could potentially enjoy the full benefit of that price increase. However, with a covered call in place, you are limited to the strike price plus the premium earned. Understanding the impact. Strike price selection. The strike price you choose for the call option significantly impacts the trade-off. A higher strike price allows for more potential stock price appreciation before capping your gains, but it also reduces the premium you receive. Stock volatility. The more volatile the stock, the higher the premium you can earn from selling calls. However, higher volatility also increases the risk of missing out on significant upside if the price surges. Making the choice. The decision of whether to prioritize income generation or potential capital appreciation depends on your investment goals and risk tolerance. Income-focused investors. If your primary goal is generating a steady stream of income, covered calls can be a good strategy. The income from premiums can be a reliable source of returns, even if the stock price stagnates or experiences moderate growth. Growth-focused investors. If your primary goal is maximizing capital appreciation, covered calls may not be ideal. You give up some potential upside in exchange for the premium income. Are there any risks associated with selling call options in QYLD, XYLD, and DIVO ETFs? Yes, there are several risks associated with selling call options in QYLD, XYLD, and DIVO ETFs, even though they offer the benefit of generating income through option premiums. Here's a breakdown of the key risks to consider. Capped upside potential. This is the inherent trade-off of covered calls. As discussed earlier, if the underlying stock price in these ETFs significantly increases above the strike price of the sold calls by the expiration date, the option buyer will likely exercise their right to purchase the stock at the strike price. The ETF is obligated to sell, capping your potential gains and potentially missing out on a substantial price surge. Reduced long-term growth. These ETFs typically focus on selling short-term, at-the-money calls. While this strategy generates consistent premium income, it can hinder long-term capital appreciation compared to simply holding the underlying stocks. Over extended periods, missing out on even moderate stock price increases can dampen overall returns. Lower volatility exposure. Covered calls benefit from higher volatility because option premiums are more expensive. However, these ETFs limit their upside potential by selling calls. This can lead to lower overall returns in low volatility environments, where stock prices move slowly and option premiums are less attractive. Early assignment risk. In some cases, the option buyer might exercise their right to buy the stock before the option expires, especially if the stock price increases significantly towards the strike price. This can happen due to various reasons like interest rate changes, earnings announcements, or mergers and acquisitions. Early assignment can disrupt your planned holding period and potentially force you to sell shares at a lower price than anticipated. Limited downside protection. While covered calls offer some downside protection compared to owning just the stocks, it's important to remember this protection is limited. If the stock price falls significantly, you'll still experience losses on the underlying holdings, even though you keep the premium earned from selling the calls. Management fees. These ETFs charge management fees that eat into your overall returns. Since they are actively managed through option selling, the fees can be higher compared to passively managed index funds. Underlying ETF/stock risk. Don't forget the risks inherent to the underlying holdings in these ETFs. QYLD and XYLD track specific indexes, so their performance is tied to the performance of those indexes. DIVO invests in other dividend ETFs, so its risk profile depends on the specific holdings within those underlying ETFs. Here are some additional points to consider. Complexity. Understanding and managing covered call strategies can be complex, especially for beginners. These ETFs handle this complexity, but it's still important to have a basic understanding of the risks involved. Tax implications. The premiums earned from selling calls are considered short-term capital gains, which may be taxed at a higher rate than long-term capital gains from stock appreciation. How do QYLD, XYLD, and DIVO ETFs generate income for investors? QYLD, XYLD, and DIVO ETFs all generate income for investors through a strategy called covered calls. Here's a breakdown of how it works for each ETF. 1. Underlying holdings. QYLD and XYLD. These ETFs directly hold the stocks that make up their respective indexes, the Nasdaq 100 for QYLD and the S&P 500 for XYLD. This provides exposure to the price movements of those underlying equities. DIVO. Unlike QYLD and XYLD, DIVO doesn't hold individual stocks. Instead, it invests in other ETFs that focus on high dividend-paying companies. This gives it exposure to a basket of dividend-rich stocks, but the income generation strategy differs slightly, explained later. 2. Selling covered calls. All three ETFs use the covered call strategy, which involves selling call options on a portion, or all, of their holdings. These calls are typically at the money, ATM, meaning the strike price, the price at which the option buyer can purchase the stock, is close to the current market price of the underlying stock. By selling these calls, the ETFs collect an upfront premium from the option buyer. This premium represents the income generated by the covered call strategy. 3. Key mechanics of covered calls. The option contract. When you sell a call option, you are essentially entering a contract with the buyer. You agree to sell them a specific number of shares, usually 100, of the underlying stock at the strike price by the expiration date, if they choose to exercise the option. The premium. In exchange for this obligation, the option buyer pays you a premium upfront. This premium is yours to keep regardless of whether the option is exercised. 4. Income generation. The income for investors comes solely from the premiums collected by selling covered calls. These premiums can be a significant source of income, especially in a high volatility market where option prices tend to be higher. Here's a breakdown for each ETF. QYLD and XYLD. These ETFs focus on maximizing premium income by selling calls on all, or almost all, of their holdings, typically at-the-money calls. This strategy generates a high and consistent stream of income, but it also caps their potential for capital appreciation from the underlying stocks, explained later. DIVO. DIVO uses a covered call strategy on the holdings within the underlying dividend ETFs it invests in. The specifics may vary depending on the underlying ETF, but the goal is to generate additional income on top of the dividends received from those holdings. How do QYLD, XYLD, and DIVO ETFs differ from traditional dividend-paying ETFs? Here's a breakdown of how QYLD, XYLD, and DIVO ETFs differ from traditional dividend-paying ETFs. Income generation strategy. Traditional dividend ETFs. These ETFs invest in companies with a history of paying regular dividends. The companies themselves distribute a portion of their profits to shareholders as dividends. The amount of the dividend payout depends on the company's performance and dividend policy. QYLD, XYLD, and DIVO ETFs. These ETFs use a covered call strategy to generate income. They sell call options on a portion of their holdings, or all for QYLD and XYLD, and collect premiums from the option buyers. This income is independent of the performance of the underlying companies and is not affected by company dividend policies. Income consistency and predictability. Traditional dividend ETFs, the amount and timing of dividend payouts from companies can vary. Companies can change their dividend policies, reduce or even eliminate dividends altogether. This can lead to fluctuations in the income stream for investors in traditional dividend ETFs. QYLD, XYLD, and DIVO ETFs. These ETFs typically aim for consistent and predictable income generation through covered calls. By strategically rolling their call options, they can generate a regular stream of premiums. However, the amount of premium can vary depending on market volatility. Capital appreciation potential. Traditional dividend ETFs. These ETFs offer the potential for capital appreciation along with dividend income. If the stock prices of the underlying companies in the ETF increase, the value of the ETF shares will also increase. QYLD, XYLD, and DIVO ETFs. The covered call strategy in these ETFs can limit capital appreciation potential. When they sell call options, they cap the upside potential of the underlying holdings. If the stock price rises significantly above the strike price of the call option, the option buyer will likely exercise the option, and the ETF will be forced to sell the stock at the strike price, missing out on further gains. Risk and volatility. Traditional dividend ETFs. The risk profile of traditional dividend ETFs depends on the specific companies they hold. Some companies may be more volatile than others, impacting the overall risk of the ETF. QYLD, XYLD, and DIVO ETFs. These ETFs can be more volatile than some traditional dividend ETFs. The value of the ETF can be impacted by fluctuations in the price of the underlying holdings, as well as changes in option premiums due to market volatility. Management fees. Traditional dividend ETFs. These ETFs typically have lower expense ratios compared to QYLD, XYLD, and DIVO. Since they are passively managed by tracking an index, the fees are lower. QYLD, XYLD, and DIVO ETFs. These ETFs involve active management through the covered call strategy, which incurs higher management fees compared to passively managed traditional dividend ETFs. Alright, so we reached the end. By now, you should have a good understanding of how QYLD, XYLD, and DIVO ETFs use covered calls to crank out income. It's a tempting strategy, especially for income-focused investors. But remember, there's always a trade-off. You give up some potential for growth in exchange for that steady stream of income. So, the big question, are these ETFs right for you? Well, it depends on your goals. If you prioritize income over maximizing growth and understand the risks involved, then these covered call ETFs could be a good fit. But if you're a young investor with a long time horizon and capital appreciation is your main focus, then traditional dividend ETFs or even broad market index funds might be a better choice. No matter what you decide, do your own research and understand the risks before investing. Thanks for watching. Don't forget to like and subscribe for more in-depth investment breakdowns.